Since the S&P 500's intraday low back on April 18th or several weeks ago, all the charts have continued to improve in a manner that points to more upside from a probabilistic perspective. We're in somewhat of an unprecedented era in terms of money printing from central banks. We have printing going on in the United States, Japan, and Europe simultaneously. Therefore, markets can behave in strange ways. Price in an environment like this becomes the most important thing, more important than ratios or indicators. You just have to pay attention to the markets themselves and really understand your correlations. Doesn't mean that ratios and indicators can't help you, but price has to be your primary driver to stay with the markets. When you drift from price, it can be dangerous. How do we do that? We just pay attention to what is happening, not what we think might happen, and we pay attention to what is leading. In this video, we'll cover numerous bullish charts. As they sit now, something needs to change for the bears. We'll look at that 12-year base in the stock market. We'll cover what we'll term the CCM Big Four, these charts here, and we'll look at the impact of a strong US dollar on past market scripts. Just like the stock and bond chart has been very helpful to us over the past 4 to 6 weeks, materials are at a similar point. We'll look at that chart. We'll look at the fear index and a few charts that have made important higher highs from a weekly perspective. To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right hand corner of your video player. This is a portion of one of the CCM models that we use to track the markets. These are charts in the model. If you want to know where the S&P 500 is headed, the most important thing to track is the S&P 500 itself. As you move down the list, the correlations start to deteriorate. So the higher you are, the more important you are. The lower you are, the less important you are. In this week's video, we'll look at the Big Four, the S&P 500, long versus short, stocks versus bonds, and the credit markets, junk bonds versus treasuries. Sometimes it's good to go back and look at your analysis and the charts that you've been using and ask, are they helpful? The stock market's tone changed in late April from concerned to bullish. You can see here on April 21st, our video, we noted the bulls are still in control. It was still bullish, but by the thinnest margin that we had seen in the calendar year. So on April 21st, things still look shaky. But notice in our Twitter feed here on April 23rd, we said the NASDAQ had recaptured its 50-day moving average, and then that was positive. Let's look at the chart. Here's the day that we noted it here, and look at what the NASDAQ has done since then. This is a bullish slope on the 50, and the NASDAQ has done quite well. This chart was very helpful. Go up a little bit further. April 23rd, another big change. Bad economic news in Europe hinted at more money printing. That's really what turned the markets. Here we noted that our risk model closed at 63 on Monday of that week. Told us that the bulls were still in control. April 23rd, credit spreads starting to align with the risk-on trade. If we move up a little bit further on April 23rd, again, S&P 500's 50-day looks much healthier versus the early stages of the 2012 correction. This is the chart that we posted. This is what a correction looks like. Instead of rolling over here, it started to turn back up on April 23rd at 3:13 p.m. This was a bullish signal, and notice where the S&P 500 is. It's at 1576. That's almost 100 points below where we closed on Friday. This is a long-term monthly chart of the S&P 500 index dating back all the way to the late 1990s. In the year 2000, we peaked. Resistance again in 2007. You can see we seem to have a clear bullish breakout to the upside. This could be significant. This is a 12-year base here that we appear to be breaking out of. If that is the case, significant upside could follow. Retests are possible. If we retest, probably would be back in the 1580 area, which is the low for this month. Here, you can't rule that out, but even if we did retest, the odds are high that this blue line would hold. We'll keep an open mind going forward, but it's difficult to look at this chart and read it any other way other than bullish. This is a weekly chart of IYM, or the Basic Materials ETF. It's very, very similar to XLB. Point of the exercise. This is another chart that appears to be breaking out above a fairly long-term base. You can see this is back in 2011 when the European debt crisis really started to take off. Resistance here, rejected. Resistance here, rejected. Eventually stocks corrected. Eventually stocks corrected. Rejected here. This is your outlier event where numerous charts were weak, but the S&P 500 index continued to climb. Most important thing here, this point here is higher than this point here and this point here. This is a laggard. If a laggard begins to break out, that tends to be bullish for the general stock market. Conversely, if it fails and moves back in this direction, we could see some weakness in the general market. We noted at the beginning of the video, when you have central banks printing large amounts of money, price becomes extremely important due to the distortions in the market. The US dollar appeared to be vulnerable here. This is early April. This is late April. This is an ugly looking chart here. It's righted itself and made a higher high above this high, and this high. This has a bullish look to it with the moving averages, the slopes. This has potential broad implications in terms of following market scripts. With a strong US dollar, your typical weak dollar assets such as gold, silver, materials, emerging markets may not provide leadership as they have in the past. The most important thing is to monitor the markets. Whatever is strong, and more importantly, the strongest, is where you want to migrate to. You don't want to be anticipating that emerging markets or materials or gold or silver should be doing something based upon the script of the past 3 to 10 years. You need to see what is actually happening. If gold, silver, emerging markets, and materials provide leadership with price, then we can look at them. But they have to lead with price. Now we'll begin the trek through the big four charts. This is a weekly chart of the S&P 500 index. Moving averages here, 3-week exponential, 5-week. There's nothing particularly magical about these numbers. The important thing is that you track them in some meaningful way. A lot of it depends on what your time frame is. Our time frame is weeks, months, and years, not hours and minutes and days. This is a market peak in red. This is a bottom in green, a peak, and a bottom. In our models, we track numerous indicators that you can see here, and we'll cover a few of them quickly. It's a lot of information there. If we go back to our spreadsheet, you can see that based upon our weights and the way we look at those indicators, we don't weight them all equally. Some of them are more important than others. Price is the most important thing. So from that chart, price, the moving averages, the slopes are weighted the highest, and the indicators get varying degrees of lower weights. Point of moving back to the spreadsheet, as of the close on Thursday, May 16th, 2013, up here at the top, roughly 98% of the questions that we ask about that chart are coming back with a bullish answer. Moving back to the weekly S&P 500 chart, we'll look at some indicators here to give you an idea of what we would be looking for in terms of bearish implications or becoming more concerned about the rally. Remember, red is a peak, green is a bottom in the S&P 500 index. If we scroll down here, this is the S&P 500 weekly here. This is the weekly CCI indicator. You'll notice on some of these that we've changed from the default on stock charts, so it's important that you know what the settings are. We've used custom settings in these models. The concepts apply no matter what settings you use. CCI, point of the exercise, when it's in overbought territory, which is above 100 here, when it turns green, when you're in overbought territory, good things tend to happen for the stock market. And even when the market peaks here, not too many bad things happen until you move out of overbought territory. Overbought, good things happen. Overbought, good things happen. Point of the exercise, to become more concerned, we'd like to see CCI move out of overbought territory like this and this, where weakness in the stock market followed. This chart you can see is clearly in overbought and bullish territory. This is chart 2 of the big four. Now we're looking at a weekly long versus short. Why do we look at that? It's a good indication of where we want to be from a binary perspective. Would I prefer to be long or would I prefer to be short? You can make an argument that this chart is extended, it looks extended, your indicators are extended. True. The price can stay like that and the indicators can stay like that for an extended period of time. This is roughly a 3-month period here where you could have made that argument here, but stocks went up for another 2+ months. Therefore, we're only 1 month into this extended type look. You can also see from a trend perspective, resistance, 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 breakout. It appears as if we tested this trend line here twice, and now we've made a higher high. Longs versus shorts look bullish, and until something changes, we'll be bullish. This is chart 3 of the big four. Again, stocks, SPY, relative to bonds. Would I rather be in stocks or would I rather be in bonds? Fairly logical question. We looked at this consolidation period, the point of showing it. This has been very, very helpful. The stock market's done quite well in the past few weeks after this breakout. This chart looks healthy as it stands now. Let's take a step back and look at the same chart in terms of what these moving averages are telling us. This is stocks, S&P 500 relative to bonds, AGG. Can you get whipsaws? Sure you can. Here's a bullish cross. Here's a bullish look that was quickly reversed. If you know going in that you can get whipsaws, you account for that by using multiple charts and multiple indicators, and you look at the weight of the evidence. Point of the exercise here. Here's a bearish cross, blue below red. Bad things happened. This is a bullish look, price above both moving averages. Blue above red, there's a bullish cross in here. Good things tend to happen. Here's a bearish cross. Blue goes below red. Bad things tend to happen. Bullish cross, good things. Bearish cross, bad things, good things. You can see as we sit now, going back to early March, This chart looked very unsettled, and it looked a little bit like this peaking process here, here, or here. You can see the resolution has been bullish. Now this chart looks bullish. It looks more like this period here or this period here. This is chart 4 of the big 4. This is junk or riskier bonds relative to more conservative long-term treasuries. You can think of this as risk on relative to risk off. When the ratio rises, higher yield and riskier instruments are in greater demand relative to treasury bonds. When the ratio falls, investors are migrating towards more conservative treasuries, and they're in greater demand relative to riskier junk bonds. Risk on, risk off. Point of showing this, the current state of it as of the close on Friday, May 17th. This video is being recorded on Sunday, May 19th. This chart looks bullish. Blue above red, slopes up, price above. We also made a higher high on a closing basis last week. As long as this chart is in this mode, we'll err on the bullish side of the ledger. Also note, overbought territory. But you can make an argument overbought means we're about to reverse. Not necessarily. Overbought territory. Look how long the advance continued in the ratio and the stock market after overbought territory was hit in December of 2012. This is an updated version of a risk-on, risk-off chart that we've been following in these videos for months. S&P 500 relative to bonds, stocks relative to bonds, risk-on, risk-off. Point of showing the chart. This annotation has been on this chart for literally months, saying if this ratio cleared this pink line and held it, it would be bullish for the stock market. You can see here the breakout failed. Here it has not failed. We made a higher high here, which was important. Was the chart helpful? Close here on April 26th for the S&P 500 was 1582. Since we had the convincing breakout, the S&P 500 is tacked on 85 points in 3 weeks. So this chart still looks bullish, and it's been extremely helpful in terms of helping us allocate properly towards stocks and away from bonds. This is a weekly risk-on, risk-off chart. This is the S&P 500 relative to the fear index. Bearish cross, stocks do poorly. Bearish cross, stocks do poorly. This is a weekly chart, so these are fairly significant and lengthy moves down. Here you can see the chart looks healthy, however, not in a convincing manner. This chart has about 58% of the answers were yes as of the close on Thursday, May 16th. Probably improved a little bit after the close on the 17th. But this is one chart that's not fully convinced yet, but the correlation of this chart relative to price for the S&P 500 is relatively low when you compare it to the other charts that we've reviewed. This still errs on the bullish side of the spectrum. This looks bullish. We'd like to see a higher high made here in the ratio. It appears as if we've broken above a downward sloping trend line here in a bullish manner. Moving over to small caps in isolation, IWM weekly, this is what a convincing higher high looks like. As of the close on Friday, May 17th, this chart looks bullish. Moving averages, bullish. Blue above red, bullish. Price above moving averages, bullish. Slopes up, bullish. Higher high, bullish. Overbought territory, bullish. Good things can happen for quite a while after you're in overbought territory. Overbought, good things happen. As long as this chart looks like this, the outlook for small caps is positive. Very similar situation here. Everything that we said about the small cap chart, the higher highs, the moving averages, applies to risk on versus risk off, stocks versus bonds, S&P 500 relative to long-term treasuries. Risk on, risk off. Stocks up here do well, stocks roll over and do poorly. Bullish, look here, overbought. As long as this chart looks as it does as of a close on May 17th, risk on is in control relative to risk off. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.